Hello, welcome to today's video where we'll be looking at the earnings of four alternative asset managers that reported earnings this week. It's been a while since I've done a stream or done one of these more finance oriented deep dives. So it's figured, if the February coming up, Chinese New Year, why not? And why not start off with just going down the line. Blue Owl just reported this morning. Haven't looked at it yet, but generally speaking, right, when it with these alternative asset managers, I think the way I think about them, right, is uh, or the way you can think about financial services in general is like the joke is like, the entire entity is basically a group of reasonably intelligent people whose goal is to make money. Uh, and of course, how to make money can differ. Whether it's a bank, potentially having some transaction fees to, right, these alternative asset managers, right, Blue Owl, KKR, Apollo, Carlyle, where uh, there is much more of a performance alignment per se. Um, of course, all the principal agent problems, asset manager fee skimming versus performance. I think as we'll see in some of these, like in Carlyle's report, and also KKR's, how they're changing their compensation uh, is indicative of how these firms, to some degree, are addressing those concerns. Give me a second as I find the right KKR recitation. Is that is the strategic update? Here we go. Let's start up below. Credit GP strategic, which is Dial, which is actually a pretty fun strategy, heuristically, of basically being like not a fund of funds, but basically buying like the actual ownership stakes in the various general partners, right? So like Sixth Street, right, is an investment firm, alternative asset manager, I suppose you can say. Of course, at a somewhat smaller scale, and then Dial, or I guess we probably rolled it up. Blue Owl then owns the stake, so it is a pretty elegant solution in my view. And I'm playfully, I haven't talked about it too much, but to any practitioners. But I imagine if you're an LP, like it is an interesting way to, right? Because if you're an LP, like say you're like an endowment, you probably have a bit of a annoyance at paying a lot of uh, fees, just conceptually, or whatever, drag on performance compared on the net versus the gross. So if you can, so the joke was, here's the example: if you have an allocation to Dial, then it's like you're somewhat hedging out or balancing out the fee components. But then of course you're paying Dial fees, so it's like how much is a double negative if there's still a third negative around the corner. But yeah, I think it's an interesting strategy. I think at the scale, right, at 50 plus billion, I think it's. I don't think any of these other guys, right, has an equivalent platform. And the bigger picture, right, is if you have $50 billion of asset under management to be a GP strategic capital provider, to provide capital to GPs, I don't think KKR, Apollo, or Carlyle are the guys who are taking money from Dial, which implies that in the alternative asset manager space, there's a lot of platforms that are out there, and you can see that in public markets with like PX or P10, which is a small player, which is sort of like the most prominent example. Private markets, you have VINP for like Latin American alternative investing, which is public. So interesting distinction that Blue Owl has, like real estate, and of course, and 165, just to contextualize. capital return, right? Fee-related earnings, distributable earnings, right? Always, of course, uh, fund minutia, and of course, right, the difference between GAAP net income versus then these alternative uh, metrics that we like in the other presentations is the industry standard. Permanent capital, always wonderful. AUM not paying fees yet, right? Because of course, when you raise a fund, you're not going to invest all of it or deploy all of it in one day or on day one. So some of us not going to be called, and generally speaking, it's a bit unfair to charge management fees on dollars that have not been deployed. More fundraising. Compensation benefits, right? The big expense driver for these alternative management firms, right? Consistent management fee progression, right? Heuristically speaking, right? More AUM, more management fees, just right base number times the corresponding percent. Of course, imperfect, right? Maybe if fundraising is tough, you have to give a fee discounts or fee suspensions for the first couple of years. But heuristically speaking, it's an upward trajectory, and especially when you have permanent capital, right? That kind of pretty durable, right? Is the implication of the permanent side, in contrast to right having to worry about fundraising for the next fund and fluctuations of your inflows and outflows, which can be affected by things that are outside of your control, right? Broader concerns, right? Private wealth fundraising versus institutional, right? And of course, all of these alternative asset managers have idiosyncrasies, but one of the more prominent ways in which they differ is just their exposure to wealthy individuals as a source of fundraising. And you see some players like Apollo or KKR. For example, KKR mentions they have an arrangement with, maybe it was Apollo. I think KKR, they have in the most recent quarter, they consolidated General Atlantic, or not. They purchased the remaining 40% of an insurance company, right? And so, and the entire point, right, is at the end of the day, right, these alternative asset managers, right, like the goal is to have AUM, right, capital that can be deployed, or capital enough GP capital to encourage LP capital. And so the point is, right, at the end of the day, like you do need to fundraise to some degree. And so the differentiator comes from the exposure to private wealth fundraising versus institutional fundraising. And then, of course, then like internally or minority owned insurance companies. And of course, with insurance companies, right, with the float, right, from the premiums that are paid that aren't going to be paid out until, or if at all, until some point in the future, right. And so that is a point of differentiation. And of course, Apollo has been having like a timeline, like relatively early adopter of having that subsidiary insurance AUM and affine. Whereas KKR consolidating with some Global Atlantic. I don't want to mix up with General Atlantic, the other investment firm. I think Blackstone, and you can get Blackstone with like B REITs, right, which has been in the news last year. Has a bit more, at least heuristically, from what you read, a bit more of a wealthy individual, financial advisor distribution tilt. good old appendix stuff. But yeah, so Blue Owl, right? Only 28 slides, of which only 15 had specific information, right? And I think that those just show, right? There's a lot of like of course, nuance you can get into, right? Compensation. Some of these alternative asset managers, because right, these were originally partnerships or private things. So some of these, or some of the more boutique investment banks like Moelis, have unique ownership structures with how much is actually owned by the public entity versus a carve out for the founding partners, uh, or how performance fees are distributed among employees versus more traditional stock options. And so there's a lot of nuance in that regard, but I think heuristically, I think like this Blue Owl report just shows how heuristically, at a high level, like the thesis uh, isn't incredibly nuanced. It's kind of like the 1 minute pitch, right, for alternative asset managers uh, is that it's a space which has uh, benefits to scale, right? Franchise of your brand, distribution uh, to financial advisors, uh, the need for alternatives or the attractiveness of alternatives is probably going to grow just as there's more capital chasing returns, whether from institutional investors to private individuals. And of course, it's unlike public market stuff, you can't go passive in private uh, conceptually. So you're gonna have to go to one of these players, and so right, and that ties into the AUM, right? Back to that previous chart we had, right? More AUM, more management fees, generally speaking, more distributable earnings to investors, self-fulfilling cycle, right? Positive returns, funds get reinvested or redeployed, right? Permanent capital, so it's a nice flywheel. Of course, flywheel is a bit of an overused term, but heuristically, that is what it is. And of course, like there are risks. But I think the one thing, right, is uh, to agree with Paramount has been in the news with with uh with the Redstone family potentially selling, and or like the Ellison guy from Skydance. And these are points, right? Like there is like an implied bottom to your price because someone's going to buy it at some price. I think the same goes for these alternative asset managers, include also the public managers like Artisan or Victory. Of course, to a lesser degree, because public is a bit more commodified than private, just from that barrier to entry, right? I think in public side, right, you look at BlackRock, or, right, it's much more scale, and of course, scale does matter in private space, but I think on a public side, like the kinds of scale, even probably much more substantial, just given how on the private side at the end of the day, it is relatively manually intensive, whereas public side, like, you really can um, pull some levers at scale. Yeah, so that agree, right? When I think about alternative asset managers or asset managers in general, there probably is also a floor price that someone's gonna to buy your firm at, right? Because your firm, even if you're gonna get acquired by another manager, so maybe there's gonna be some redemptions, but probably not everybody's gonna redeem out. It's really not, to some degree, not until whatever specific fund they allocate to has concluded. Then the new shop comes in, maybe returns suffer, maybe returns are good. Some people leave, some people stay, but whoever's buying is probably getting a chunk, nice chunk of AUM, right? And then that ties back into the overly simplistic, but broadly speaking, accurate, right? More AUM, more management fees, more distributable earnings. Everybody's happy. And of course, I don't think any of these alternative. I think because of how simple a thesis is, and what I like, it's not like any of these alternative asset managers, maybe PX to some degree, are really trading at the uh, low valuations, right? Even PX isn't trading at low valuation. But yeah, it just shows, right, like the market, the average investor is willing to pay a decent price for that type of story. KKR, right? And here my point, right, of the insurance side of their assets, right? Here we see it. Again, fee-related earnings, book value per share. Didn't notice that in the Blue Owl. Blue Owl note. So KKR, you're probably paying 2 to 3 times book value, right? I mean, there's some banks out there that trade for a higher book value, which is always interesting, right? But just show like the difference in scale that can exist, right? AUM here 553 billion, Blue Owl 165, which just shows the different scale that exists. Oh, here it is, Global Atlantic, right? So this is the insurance company that KKR had a majority stake in, and that they're now going to buy out and own 100% of. Again, management fees, right? Fee paying AUM, permanent capital, and of course, right, you can contrast the difference in permanent capital. Here is 130. So much of the vast majority of Blue Owl's capital is permanent, whereas KKR only roughly under half is, right? Which again, right, of course, absolute dollars are different, but just shows how, right, and just the difference in like the legacy of like where the starting point is for these different players. Called commitments. Investment performance, nice of them to share a glimpse, right? Real estate, yeah, not much you can do. Credit, good old traditional P. Not sure how much middle market, quote unquote middle market, they do. But again, right, the insurance point. Of course, if you have an insurance business, you are running an insurance business, right? So you have some of the associated costs. So it's not a perfect thing, right? And of course, insurance businesses, you can look at some of the pure play public companies which are out there, insurance or reinsurers, and there's a decent amount of them. You're just looking at the U.S., right? You have Progressive, you have State Farm, Travelers, a good amount of smaller players, and then right, you have your European comparisons like Swiss Re, Direct or DIISY in the UK, Munich RE, and then you have like AIA out in Asia, right? So there's a good amount of insurance companies out there, and of course, right, like you have to be at Markel, right, at Berkshire. If you want to go to Geico, right? And so points, right? Insurance, right? It's not an easy thing to do. So of course, there's risk. Manulife, yeah, MetLife, right? Moving risk around, getting paid to take something off somebody else's hands. A book value. Here's a nice visualization, right? I suppose it's a fun semantics debate what the difference between traditional and core PE is. Nice. Here's like you think about true generic PE company, like something like Arnott's Biscuits probably is something that comes to mind as your generic PE company. But here's some more detail, which is always nice compared to what other guys perform. But again, right, you see the same patterns happening, right? Of course, we could have Blackstones up here, or earnings reports also. But I think I'm just looking at 4, right? 4 is a decent sample size for the alternative asset manager space. Um, I don't think, yeah, I don't think you'd be missing out on any private manager. I guess Ares. Well, we won't be looking at Ares or Blackstone, which is two players. Um, those are the only two that come to mind. I guess a PX. I'm talking about them. If you think about public U.S. alternative asset managers, like really, it's like these four plus those three or seven. Uh, I'm blanking on it. And of course, right, BlackRock has its private solutions. Um, and of course, there's some really big name firms out there, right, like PIMCO or uh, and of course you have CVC potentially going public in Europe at some point. So it's, but again, right, it's kind of, you need to get to a certain scale of AUM for being public to be worthwhile, right? And you could kind of start to guesstimate, right, what that, and probably Blue Owl being one of the newer, right, went public through a SPAC in 21, PX, which is smaller, I think like 80, 90 billion AUM. And you think about that, well, if like Blue Owl and PX probably are smaller public companies are out there, and they're at 80 to 165 billion of AUM. Well, it's a PowerPoint. Like there's a lot of capital coming into the space, but at the end of the day, like 80 billion AUM, that is a lot of capital to have. So, and again, right to the PowerPoint, like being acquired by somebody else, being rolled up into another firm, right? That's always there. And so the point is, either way, you have a decent selection of alternative asset managers that you can pick from, at the very least, N of 7. And then if you want to push out to insurance companies, then your universe widens a lot more. Here we see fundraising, right? Global Wealth, um, right? Apollo Academy, Apollo Academy uh, for individual investors. Apollo with their Torsten, I forget the last name, like something LOK, has like a decent, a pretty good, daily email thing where they show a chart. Sometimes do like deeper presentations that you can look at. So it's not a bad thing to subscribe to. Probably a bit more substantive than a lot of the daily newsletters that get sent out. Compensation, yeah, retirement services, right? Hinting at the insurance component of AUM. Affine, right? Apollo's insurance. Always a nice, you know, these charts are always nice. It's always good to see, what are the quote unquote levers of return. Principal investing, again, right? Dry powder, AUM, investment performance. Again, right here you see private equity. You know, probably not too many exits in the last quarter. Shame they don't mention it. Here we go. So again, right, like same points continue to get hit on, right? And we see for all these guys, right, like relatively up and to the right curve on, earnings, fees, and rounding out Carlisle. And of course, Carlisle has probably been a bit more trouble than the other guys with leadership changes and the effect it has on fundraising. Uh, but it seemed that the market liked what they saw. And here we see, right, the realignment of our employee compensation program, which again goes back to the point about, the challenges you have, right, of balancing like your management fees and your performance fees. And the heuristic, right, is, investors tend to like predictable cash flows, right? And if you look at all those charts of, of management fees, right, that are up and to the right, like management fees are pretty dependable or consistent. Whereas, as we just saw, some of the private equity returns, right, like your performance fees probably weren't there because, your performance depends on, idiosyncratic market factors. And so the general heuristic is, you know, the public investors want your management fees, and your employees would also like the management fees, but well, maybe your employees can just get uh, more of the performance fees, to align incentives or to distribute the pie that way. And or of course you can just do um, stock issuance, right, which Apollo did to some of their guys like Zito. Um, and so Carlyle is going about it one way as well. I think Carlyle's way, not necessarily as much stock, more so just bumping up the amount of performance fees that employees get. And here we see, right, Carlisle 426. And so to that point of Carlisle, quote unquote, having a tough year with the leadership changes, right, compared to like these guys, right, they're in line, right, with AUM, definitely one of the larger players. And again, here's the point I just made, right, increasing the management or the performance fees, reducing the management fees, right, and shareholders get the cash flows they like better. Employees get the potential cash flows that they're happy with. Again, wealth management, or not management, but like targeting wealthy individuals, right? Again, right, same terms keep on popping up. Fundraising. I've not seen permanent capital yet. Right, up and right, heuristically speaking. Again, right, private equity performance, and not the best in the past quarter or year. Fortitude, I'm thinking, is their term for permanent capital. We see some underlying companies, again, like Silverglass. That probably sounds like your generic, industrial company that private equity does. But yeah. So that was a bit of a highlight. I do probably should run the class. But that's a high level overview of alternative asset managers. I've talked about them in the past, uh, but again, right, always good to have more information. And as it's probably been an inflection point, whatever market conditions or um, the reshuffling of some of these firms, that gives a bit more clarity for the future. At the end of the day, right, with the common points that all of these presentations seem to hit on, right, like there is a clear, you know, similarity in what the drivers of return are for these alternative asset managers, and of course, right, you might not necessarily be considered an accredited investor or have the access to allocate capital to and like the high net worth individual strategies that these guys offer. But you can, of course, generally speaking, have a brokerage account and own a nominal ownership stake in the GP. And at the end of the day, maybe being the GP is better than being the LP. Uh, and so, but yeah, always good to look at presentations and look at the nice slide decks people have. But these are some alternative asset managers. Of course, we haven't looked at Ares, we haven't looked at Blackstone, we haven't looked at PX. And of course, all the insurance companies and of course public managers that are out there. But as a quick snapshot, I think the same general points are hit across the board. And so thank you for watching. Feel free to comment, ask a question, and I'll link to these in the notes. But yeah, thank you for watching, and have a great rest of your day.